Imagine you have an 850 FICO score. Perfect. Zero late payments in your entire life. 7% credit utilization. You've done everything right. You're basically the teacher's pet of the credit world. Gold star. A++. And then, your new credit card offer arrives in the mail. 29% APR. If you're black in America, this isn't imagination. This is Tuesday. Today, I'm going to show you the math that banks really don't want you to see. We're talking government studies, federal settlements, and exposed internal documents where bank employees literally called black customers mud people. Yeah, we're going there. By the end of this video, you're going to understand exactly how much money is being extracted from black Americans with perfect credit, why algorithms are the new redlining, and what you can actually do about it. Let's get into it. So first, let's talk about what a perfect credit profile actually looks like. Because banks love to pretend this is complicated, it's not. A FICO score between 800 and 850 means you're in the top tier. You've never missed a payment. Your credit utilization is under 10%, meaning if you have a $10,000 limit, you're using less than $1,000. You have a diverse credit mix, maybe a credit card, a car loan, a mortgage, and your accounts have been open for years. If you hit these numbers, you should be getting the best rates available. We're talking 15 to 20% APR on credit cards, 4 to 6% on mortgages, 7% on auto loans. That's the deal. That's what excellent credit is supposed to mean. But here's where it gets wild. A 2023 report from the Government Accountability Office analyzed over 650,000 credit card accounts. They controlled for everything: credit score, income, debt levels, geographic location, and after removing every variable that should matter, black cardholders were still paying 0.72 percentage points higher APR than white cardholders with identical financial profiles. 0.72% might sound small, but remember, this is after accounting for credit score. This is pure, unexplained disparity. The only variable left is race. And here's the kicker. The raw gap, before controlling for anything, was 2.17 percentage points higher. That's not a rounding error. That's a system. Let me show you what this actually costs. Say you have a $5,000 credit card balance. At 20% APR, which is what you should be getting with excellent credit, you'll pay about $2,900 in interest over 5 years if you're making minimum payments. But at 22.17%, the rate black cardholders actually receive on average, that same balance costs you $3,184 in interest. That's $236 more for the same debt with the same credit score. Now scale that up. Most Americans carry $11,000 in credit card debt. Over a lifetime of credit card use, we're talking thousands of dollars extracted for no reason other than the color of your skin. But credit cards are just the appetizer. Let's talk about the real money. Mortgages. A study from UC Berkeley looked at millions of mortgage applications and found that Black and Latino borrowers pay 5.6 to 8.6 basis points more on home loans than white borrowers with identical qualifications. That doesn't sound like much until you do the math. On a $300,000 mortgage at 6.5% over 30 years, you'll pay $382,000 in interest. But at 6.586%, just 8.6 basis points higher, you pay $387,000. That's $4,500 more for the same house, with the same income, with the same credit score. And it gets worse. Researchers at MIT calculated what they call the racism tax on black home ownership. When you add up higher mortgage rates, denied refinancing opportunities, mortgage insurance premiums black homeowners pay at higher rates, and property tax disparities, The total comes to $1,665 per year in extra costs. Invested over a typical homeownership period at market returns, that's $67,320 in lost retirement savings. $67,000. Not because of bad decisions, not because of poor credit, because of skin color. Now let's talk about card, because this is where it gets really blatant. A 2023 study published in the Review of Financial Studies found that black borrowers pay 0.7 percentage points higher on auto loans than white borrowers with comparable credit. And here's the part that made me actually laugh out loud when I read it. Black borrowers default less than white borrowers with similar profiles. Let me say that again. Black borrowers are statistically more reliable, and they still pay more. There's literally no risk-based justification. It's just bias. On a $25,000 car loan over 5 years, that 0.7% difference means $465 in extra interest. But if you get hit with the maximum dealer markup, which black borrowers receive far more often, you're paying $1,436 more. The National Fair Housing Alliance did undercover testing at car dealerships. They sent in testers with different races but identical credit profiles. 62.5% of the time, the non-white tester with better credit got worse financing than the less qualified white tester. 62% of the time. The person with better credit got the worst deal because of how they looked. Now you might be thinking, okay, but surely this is just some bad actors, right? A few racist loan officers here and there? Let me introduce you to the Department of Justice's Combating Redlining Initiative. Since 2021, the DOJ has secured over $150 million in settlements from banks caught discriminating. And the stuff they found isn't subtle. Trident Mortgage Company settled for $24.4 million. Investigators found emails from employees using racial slurs and calling minority neighborhoods ghetto. A senior vice president was photographed in front of a Confederate flag. Their marketing materials showed only white people. 64 of their 68 loan officers were white. City National Bank paid $31 million. They had opened exactly one branch in a minority neighborhood over 20 years. One in 2 decades. Wells Fargo settled for over $175 million after internal documents revealed loan officers calling black customers mud people and referring to subprime lending as ghetto loans. In Chicago, black borrowers paid almost $3,000 more in fees for the same loan amount. This isn't ancient history. These settlements are from the last few years. But here's where it gets really interesting. Even when you remove the humans, the discrimination continues. Because now we have algorithms. Banks love to say their lending decisions are objective because a computer makes them. No human bias, right? Wrong. A 2024 study from Lehigh University tested AI systems including GPT-4 and Claude for mortgage underwriting decisions. The results were disturbing. The AI consistently recommended denying more loans to black applicants. It recommended higher interest rates for black borrowers. White applicants were 8.5% more likely to be approved overall. For borrowers with a 640 credit score, white applicants were approved 95% of the time. Black applicants, under 80%. Same credit score, different outcomes. How does this happen? The algorithms use what researchers call proxy variables. They don't ask your race directly. That's illegal. Instead, they ask your zip code. And because of decades of housing segregation, zip code effectively encodes race. They look at your educational institution. School rankings correlate with race. They look at your employment type. They look at your previous credit sources, like whether you've ever used a payday lender, which are concentrated in minority neighborhoods. The machine doesn't know it's being racist. It's just optimizing for patterns in historical data. And the historical data is racist. This is what redlining looks like in 2025. They traded the red pen for a neural network. Speaking of redlining, let's do a quick history lesson, because this didn't come from nowhere. In 1934, the federal government created the FHA to help Americans buy homes. Great idea, right? Except the FHA explicitly refused to insure mortgages in or near black neighborhoods. Their 1938 underwriting manual literally stated that incompatible racial groups should not be permitted to live in the same communities. Between 1934 and 1962, only 2% of $120 billion in federal housing subsidies went to non-white families. 2%. White families bought homes in the suburbs for about twice the median income. Those homes now appreciate to 6 to 8 times median income. That's generational wealth. Black families were systematically locked out. Today, the median white family holds $285,000 in wealth. The median black family, $44,900. That's not a gap, that's a canyon, and it was engineered. The 2008 financial crisis made it worse. Black household wealth declined 53% between 2005 and 2009. White households, 16%. The subprime crisis destroyed an estimated $164 to $213 billion in wealth from communities of color. Before 2008, white families were 4 times as wealthy as black families. By 2010, they were 6 times as wealthy. We went backwards. So what do you actually do about this? First, shop multiple lenders every single time. Don't accept the first rate you're offered. Black borrowers who shop around and negotiate can often close the gap, but you have to know the gap exists to fight it. Second, consider credit unions. They're member-owned, nonprofit, and research shows they discriminate less than traditional banks. Not zero discrimination, but less. Third, know your rights. The Equal Credit Opportunity Act makes it illegal to discriminate based on race. If you're denied credit, you have the right to know why. Request that explanation in writing. If something seems off, file a complaint with the CFPB. Fourth, build wealth outside the banking system. Invest in stocks. Invest in real estate. Build income streams that don't require bank approval. The less you need to borrow, the less they can extract. And finally, talk about it. Share your rates. Share your experiences. The system survives because people don't compare notes. When we share information, patterns become visible, and visible patterns can be fought. Look, I'm not going to pretend there's an easy fix here. This is a system that's been extracting wealth from Black Americans for 90 years. It survived the Fair Housing Act. It survived the Civil Rights Movement. It's learned to hide behind algorithms and proxy variables. But awareness is the first step. You can't escape a trap you don't know you're in. If this video opened your eyes, hit subscribe. I break down how money really works, who the system is actually designed for, and how to build wealth despite it. Drop your own experiences in the comments. Let's compare notes. I'll see you in the next one.